witnesses and guests, welcome. Next year, a number of provisions from the 2017 Trump tax cuts will expire. Republicans have made clear their plans to add $4.6 trillion to the deficit by extending these provisions. $4.6 trillion, according to the latest estimate by the nonpartisan Congressional Budget Office. $4.6 trillion to enact another budget-busting windfall for the wealthy. Democrats are fighting to reduce the deficit, fix our corrupted tax code so that big corporations and the wealthy pay a fair share in taxes, and invest in an economy that works for everyone, all while ensuring those making less than $400,000 don't see their taxes go up. That's our work window, you might call it. Today we'll look at one option, making Wall Street pay a fair share of taxes. In 2008, Wall Street's reckless speculation caused a major economic catastrophe for America. Millions of Americans lost their jobs. More than half of American families lost at least a quarter of their assets. That economic shock piled on debt, and it haunts me as I hear the warnings about climate-related economic shocks ahead of us. From an economic fairness perspective, Wall Street riches accrue more and more to the already extremely rich. 1% of Americans now own 54%, more than half, of U.S.-owned shares in the stock market. Foreign investors own 42% of all corporate shares. Median CEO pay of companies in the S&P 500 hit a record $15.7 million. This chart shows the relative growth in worker wages, productivity, corporate profits, the pay of the top 1%, and then spiking northward CEO pay. Worker pay since 1978 has indeed grown somewhat, but economic productivity grew at 4 times the rate of workers' wage growth. The increase in productivity did not flow commensurately through in worker wages. And executive pay has grown more than 18 times faster than the productivity growth. So if you do a little math and multiply 4 times wage growth is productivity growth, and 18 times productivity growth is CEO pay growth, you get 72 times as the rate at which CEO pay growth has exceeded ordinary working wage growth. Too often, these Wall Street profits come from trickery, like stock buybacks that reward CEOs and wealthy shareholders, trickery which surged following the Trump corporate tax cut. And no surprise, real estate investors got particularly favorable Trump tax treatment. At the 11th hour, real estate investors got led into a provision Republicans had claimed was for small businesses, providing a tax break worth tens of billions for wealthy real estate moguls. Corporate taxes used to pay a fifth or more of American tax revenue. Now it's down to 6%. Many huge corporations pay 0. Billionaires pay lower tax rates than nurses and plumbers. Our tax code is corrupted and rotten, turned upside down for special interests. What can we do about it? Fix the carried interest loophole, stop rewards for offshoring jobs, lock in a real corporate minimum tax on foreign profits so huge corporations can't pay 0, raise the tax on buybacks passed in the Inflation Reduction Act, tax companies that pay their CEOs more than 50 times what they pay their average worker. Enact a minimum tax so the richest can't pay lower rates than everyone else. And, what I would love to see, use decorrupting the tax code to make Medicare and Social Security sound and safe as far as the actuarial eye can see. What's clear as Congress gears up for the 2025 tax fight is that Trump and his Republican allies plan to blow up the deficit with trillions more in tax cuts for the super rich and the largest corporations. Democrats we know will oppose that giveaway. There's a lot of conversation to be had in that space. I will say it is not enough just to undo the damage of the Trump tax law. Our tax code wasn't fair before the Trump tax law. Instead, what we must finally do is to finally decorrupt the tax code so that the wealthy and corporations finally pay a fair share to the support of this great country. With that, I turn to my friend Senator Grassley.
Thank you, Mr. Chairman. Initially, I thought that today's hearing related to federal revenues was a nice change of pace, particularly compared to the 19 hearings that we've had in this committee on global warming. As I said last year at our very first hearing concerning tax issues, so I'm quoting myself, Congress should regularly examine tax incentives, just as we should review spending programs to ensure that they're working as intended, end of quote. Unfortunately, as is evident from today's politically oriented hearing title, an objective review of our tax laws isn't what this hearing is all about. As a former chair and ranking member of the Finance Committee, I assure you passing legislation to close loopholes or shut down abusive tax avoidance strategies isn't easy. It requires much more than these kinds of hearings or appealing to a never-defined fair share of taxes. It requires building a bipartisan consensus for action and understanding issues that often can't be boiled down to Wall Street versus Main Street. After all, most Americans, not just the wealthy elite, own stocks either directly or indirectly as part of retirement plans. I just learned recently that just in the last 10 years, the number of people holding stock has increased from 52% to 62% in just 10 years. Now, I fondly recall working with my friend Senator Baucus to identify and enact bipartisan measures to close abusive tax loopholes regardless of which one of us was chairman of finance. We held bipartisan meetings and hearings to better understand the law at issue and to take account of both policy and political concerns that might arise. In contrast, I suspect that today's majority will demagogue complex issues and deride Republicans for protecting Wall Street. Well, I've got this news for you. For my colleagues on the left, the reason many of the proposals we're likely to hear about today aren't law is because of Democrat opposition, not Republican opposition. Take carried interest as just one example. Concerns about carried interest became prominent in the 2000s as private equity and hedge funds grew in prominence. In response, Senator Baucus and I called bipartisan hearings to study the issue. However, our review was immediately met with resistance, and not just from those you might expect, because I recall Senator Baucus informing me about strong pushback he received privately from certain Democrats, which ultimately led to shelving a proposal that we were actively considering. Despite this, Democrats publicly and continuously blast carried interest as a loophole for the rich and blame Republicans for its existence. Yet, when they've had full control of the levers of power, they've repeatedly failed to eliminate it. To date, the only legislative action taken to limit the use of carried interest was enacted by Republicans as part of the 2017 tax law. At the time, Democrats roundly criticized Republicans for not going far enough on carried interest, yet when they had the opportunity to address it as part of their so-called Inflation Reduction Act, they failed. This led to a left-wing publication, Jacobin, writing, quote, Democrats pretended they were cracking down on private equity moguls. The truth, Dems were actually protecting them, perhaps because private equity firms are major Democratic contributors, end of quote. Carried interest isn't the only area where the majority says one thing but legislates another way. The majority regularly decries corporate handouts and large corporations paying little or no tax, but again, their so-called Inflation Reduction Act proves otherwise. Included in this partisan tax and spending bill are hundreds of billions of dollars in new or expanded tax incentives for favored green companies. The law also includes novel new tax features such as direct pay and transferability that actually makes it easier for corporations, banks, and even private equity firms to pay little or no tax. Thanks to the Inflation Reduction Act and other legislation passed under President Biden and the Democrat majority, corporate tax benefits are now 92% higher than they were under President Trump. That's based on an analysis of Treasury's, our own Department of Treasury's tax expenditure projections. I'm all for examining perceived loopholes and looking for ways to improve the fairness of our tax code. As past chairman of the Finance Committee, I actually got important reforms passed into law. But despite all the hand-wringing, that's not a path my colleagues on the other side are taking. Thank you. I look forward to hearing from our witnesses.
Thank you, and I look forward to working with you to see to it that the share of America's corporate revenue contributed by corporations gets better than 6%, and that corporations that have very significant revenues are not any longer paying 0%. Our first witness appearing electronically today is Dr. Joseph Stiglitz, a Nobel laureate who is currently professor of economics at Columbia University. He also is chief economist and senior fellow at the Roosevelt Institute and the founder and co-president of the Initiative for Policy Dialogue. He previously served as senior vice president and chief economist at the World Bank and as a member and chairman of the Council of Economic Advisors during the Clinton administration. Next is Ms. Sarah Anderson, who is director of the Global Economy Project at the Institute for Policy Studies and co-editor of the Institute's website, inequality.org. She previously served on the Meltzer Commission, which was tasked with evaluating U.S. policy towards the IMF and the World Bank. And finally, Dr. Michael Faulkender is an associate dean of master's programs and professor of finance at the University of Maryland, and the chief economist at the America First Policy Institute. Mr. Faulkender served as the Assistant Secretary, Dr. Faulkender served as the Assistant Secretary for Economic Policy at Treasury during the Trump administration. I welcome all of you and would turn first to Dr. Stiglitz, assuming that our electronic connection can be flipped on. There he is. Please proceed, sir. You have 5 minutes. Your full testimony will be made a matter of record.
Well, thank you, Chairman Whitehouse, Ranking Member Grassley, and members of the committee. It is a great pleasure to be able to discuss future directions of tax policy with you and how the tax code can be more equitable and help create a more dynamic economy that promotes the well-being of all Americans, rather than just Wall Street and other corporate giants or the wealthiest individuals. The tax code has explicitly contributed to inequality and excessive financialization of the economy and distorted the allocation of investment towards fossil fuels and real estate and away from investments that would sustainably raise living standards. U.S. tax policy provides considerable advantages for unproductive activity from Wall Street firms and wealthy investors. In the few minutes I have, I want to emphasize 4 directions for reform. First, We need to close the loopholes and eliminate the special provisions that result in the richest individuals and most profitable firms not paying their fair share of taxes. Today, billionaires have a lower effective tax rate than working class Americans. It makes no sense that dividends and capital gains should be taxed at lower rates than wages. It is inequitable that someone who is receiving dividends in his beach resort from inherited stocks should pay a fraction of his income as taxes than that of a nurse who is working long hours to take care of us during the COVID-19 pandemic, or that a hedge fund manager uses the carried interest loophole so she can escape much of the taxes she would otherwise have to pay. Special tax provisions that only serve corporations and the wealthy have enabled and incentivized shareholder payouts, resulting in companies having fewer resources to invest. They reward companies for devoting their energies to tax avoidance rather than becoming more innovative. Companies that excel in tax avoidance grow at the expense of others. Secondly, we need to eliminate tax provisions that are directly distortionary. Our tax system provides large subsidies for the fossil fuel industry, which this committee has previously examined. Further, the tax code, by providing tremendous payouts for Wall Street, encourages the excessive financialization of the economy, making the economy less stable and increasing inequality. Third, we should use the tax code to actively create a better economy by curtailing activities that create negative externalities and encouraging those that generate positive externalities. The tax code should encourage R&D and discourage harmful economic behavior, such as unproductive speculation and excessive emissions. Finally, the tax code should aim more at non-distortionary areas where elasticities are low. For instance, it was a grave mistake not to have imposed a tax on windfall profits oil companies and other energy companies accrued in the months after Russia's invasion of Ukraine. The revenue from such a tax could have helped those who were suffering from these price surges. Taxing land has little effect on land supply, so too for natural resources. Such taxes actually generate societal benefits, for investment and speculation in these areas divert attention away from the more productive investments. The rents generated by such resources should be taxed at higher rates than those imposed on other sources of income. This is true too for other forms of rent, most notably monopoly rents. These reforms will significantly improve equity and increase the efficiency of our tax system. While there are countless others, I will conclude by proposing 10 tax reforms that would increase taxes on the ultra-rich, reduce today's extreme levels of inequality, and tackle tax avoidance. First, remove the tax advantage for capital gains over other forms of income and of CEO pay in all its forms. Secondly, implement a constructive realization policy, taxing assets based on their current value rather than only when the gains are realized. Thirdly, fully tax unrealized capital gains at death. Fourth, implement a minimum income tax along the lines of President Biden's proposed billionaire minimum income tax or Brazil's global minimum wealth tax. Fifth, increase the minimum corporate tax base. Sixth, eliminate tax subsidies for fossil fuels and implement carbon and other environmental taxes. Seventh, expand and make permanent subsidies that increase productive economic activity, such as R&D tax credits. Eighth, a financial transaction tax. Ninth, a windfall profits tax. And 10th, reverse preferential treatment for income from land and other natural resources. We can create a more equitable tax system which generates substantially more revenue and promotes growth. The principles are clear, and in many cases, their application is straightforward. Vested interest, reflected through the power of money in our politics, will stand in the way. Thank you for your time, and I look forward to your questions.
Thanks, Professor. I appreciate having you with us. Ms. Anderson, please proceed.
Thank you. I'm Sarah Anderson with the Institute for Policy Studies, and the first time I testified before this committee, it was in 2012, at a time when our economy was still struggling to recover from a financial meltdown that threw millions of Americans out of their jobs and their homes 4 years earlier. I think we can all agree that we don't never want to go through that again. And over the years, Congress and regulators have taken some important steps, but financial institutions still extract too much wealth out of the pockets of working families and shovel too much wealth into massive executive bonuses that encourage inappropriate and excessive risk. With the regional bank failures of last year, we saw that reckless executives can still drive their firms into the ground and walk away with grand fortunes while relying on taxpayer money to contain the damage. This hearing is focusing on tax policy as one tool to ensure that our financial institutions contribute to a healthy economy and encourage long-term value creation instead of short-term speculation to bump up CEO pay. As you prepare for the 2025 tax debate, which will be a lot of fun, I'm sure you'll agree, I encourage you to consider two questions. One, would our tax system be more fair if financial firms and executives contributed more to the cost of vital investments? And two, can we use tax policy to discourage financial activities that increase instability and inequality and instead incentivize activities that create long-term value? I think the answer to both of these questions is yes. First, big profitable firms are not paying anywhere near the corporate statutory tax rate. Citicorp and Bank of America paid an effective rate of 4% during the first 4 years after the 2017 tax cuts. The new 15% minimum will help with that, but we need to do more to close loopholes. Second, most Americans are used to paying sales tax when they go out to eat at a restaurant or they buy a new car. But Wall Street traders pay zero sales tax on millions of dollars in stocks and derivatives. And that's encouraged the explosion of high-frequency trading that drains profits from ordinary investors while adding no real value to our economy. Third, financial executives reap huge windfalls from our tax code's bias in favor of income from investments over income from work. We have billionaires paying a lower tax rate than firefighters or teachers, and investment fund managers still get to pay the lower capital gains rate on their carried interest compensation. Fourth, the Tax Cuts and Jobs Act gave big real estate investors yet another tax break through the 20% pass-through deduction meant for small businesses. Clearly, the financial sector can and should pay more. Now I'm going to share some thoughts on how to use tax policy to both raise additional revenue and encourage long-term value over short-term speculation and excessive CEO pay. I like to call these twofers. My first twofer is a tax increase on companies that pay their CEO more than 50 times what they pay their median worker. A recent poll showed overwhelming support for this, including amongst 77% of independents and 71% of Republicans. It would give companies a choice. They could either narrow their pay gaps, which would probably make them more profitable because extreme pay gaps tend to undermine employee morale and productivity, or two, they could choose to pay a higher IRS bill. It would be their choice. My second tax twofer is a financial transaction tax to encourage long-term investment while generating new revenue. The target of this would be the high flyers in the financial casino, while the cost to pension funds and ordinary stock and bond holders would be less than the typical portfolio management fee. My final twofer is an increase in the stock buybacks tax. Whether you were for or against the 2017 tax cuts, I think we should all be angry that corporations took their tax windfalls and spent $1 trillion of it in 2018 on stock buybacks instead of on worker wages or innovation. For too long, Wall Street has wielded excessive power to shape our tax code so their firms and executives can avoid paying their fair share of taxes while continuing activities and practices that benefit the few while putting the rest of us at risk. The 2025 tax debate is an opportunity to fix these problems as part of a broader overhaul of our tax code to make our country stronger and more equitable. Thank you. I look forward to your questions.
Thank you, and I look forward to that broader overhaul. Dr. Faulkender, please proceed.
Chairman Whitehouse, Ranking Member Grassley, Senators on the committee, thank you for the opportunity to testify today on the enormous benefits that the American people realize from having a pro-growth tax code. I've been a finance professor for more than 20 years and had the privilege of serving as the Assistant Secretary for Economic Policy at the Department of Treasury. In that role, I worked on the economic projections included with the administration's budget submission, including research on the historic prosperity that was generated following the enactment of the Tax Cuts and Jobs Act, or TCJA. Today, the American people are suffering from the harmful effects of inflation and declining real wages. As a result of excessive federal spending and onerous regulation, the American people have struggled with average price increases exceeding 19% since President Biden took office, while average weekly earnings have risen just 14.5%. For the average household, their hard work buys $2,300 less today than it did just 4 years ago. Today's hearing is about finding new taxes, such as higher personal or corporate taxes and financial transactions tax, that would further reduce Americans' wages, savings, and investment income, all to fund larger government. Let's first set the facts straight on taxes. In fiscal year 2022, federal receipts were the equivalent of 19% of aggregate economic output of our nation, the second highest since World War II. Between TCJA enactment and fiscal year 2022, corporate income tax payments rose 43%. Personal income tax collections rose 66%, well faster than inflation. We do not have a revenue problem, we have a spending problem. According to CBO, spending for the next 10 years will continue to be 23 to 24% of national output, well above the 20.3% that it averaged for the 50 years prior to the pandemic. While a national emergency may necessitate temporarily elevated spending, the national emergency is long over. In terms of who pays taxes, in the latest year for which data has been made publicly available, the top 1% of households earned 26% of income and paid 46% of total federal income taxes, well more than their share. The United States has one of the most progressive income tax codes in the developed world, and the Tax Cuts and Jobs Act made it more progressive. On the corporate side, TCJA aligned the corporate tax rate with what corporations were paying in much of the rest of the world. Through provisions like GILTI and BEAT, we further incentivized economic activity to take place and be recognized here. The result was that capital investment accelerated, more than $1.7 trillion of foreign capital has been repatriated, and tax inversions have essentially ended. While one may think that higher tax rates would generate higher tax receipts for the government, the Laffer curve explains that higher rates deter economic activity. A higher tax rate paid on less income can result in less income for the government. Additionally, while some of the changes in corporate tax rates pass through to investors, higher corporate taxes also result in higher prices for consumers and lower wages for working families. This is consistent with the economic prosperity our nation realized immediately following enactment of TCJA. Inflation-adjusted incomes jumped a record $4,400 in 2019, compared to falling $2,080 since 2020. Some are proposing a wealth tax to punish successful entrepreneurs. Taxing unrealized capital gains would drive away long-term venture capital investments in leading industries like life-saving biotechnology and low-cost, reliable energy, where cash flows often may not be realized for 10 years. Likewise, some are looking to enact a financial transaction tax, which is essentially a fee on trading that will get passed along to the American people. Sweden enacted a financial transaction tax in 1984, after which trading volume declined precipitously, and repealed it in 1991. Higher taxes on top of the growing regulatory burden coming from the SEC would just accelerate the movement of innovation offshore and further degrade our position as the financial capital of the world. Yet many of the same people calling for higher corporate and personal income tax rates are advocating that we repeal the cap on state and local income tax deductions, or SALT. According to a 2021 study by the Tax Policy Center, 70% of the benefit of repealing the $10,000 cap on SALT would go to those making $500,000 or more. It's hard to think of a more regressive tax policy proposal. Our nation needs to address the staggering budget deficits that have put us on an unsustainable fiscal path. Rather than taking even more money out of the productive side of our economy, the American people would benefit from repealing the $1 trillion of green spending in the IRA, stop the Biden administration's illegal student loan forgiveness, return non-defense discretionary spending to pre-pandemic levels, and reverse the regulatory burden that has caused inflation. Thank you for including me in today's discussion, and I look forward to your questions.
Thank you, Doctor. Dr. Stiglitz, let me begin with a few more broad and general questions for you. First, does economic inequality itself have economic consequences? And what happens to those economic consequences as economic inequality worsens?
That's a great question. It used to be thought that there was a trade-off. Arthur Okun, who was chairman of the Council of Economic Advisors under President Johnson, wrote a book called The Big Trade-Off. And the argument then was that if you want to reduce inequality, you would have to accept lower growth. But that thinking has totally changed. And now we know that countries face a high price for inequality. The IMF studies have, and IMF is not a left-wing institution, has shown that is the case. It was the central piece of my book called The Price of Inequality. One of the reasons for that is as you get more inequality, the adverse effects get worse, and we've had an increase in inequality. And the ways in which inequality has increased related to monopolization, financialization, also have adverse effects on the economy.
In the context of the harms that are driven by economic inequality, could you elaborate a bit on the extent to which our tax code actually contributes to economic inequality and hence to the economic evils that follow?
It contributes in several different ways that have already been highlighted. One of them is that it leads to increased financialization of the economy. The financial sector, in turn, has engaged in activities that, like predatory lending, but even apart from that, just increased debt leads to greater instability, and that instability, the brunt of that is borne by ordinary Americans, so it increases inequality. Our tax code encourages real estate speculation, provides preferential benefits for CEOs. We've already had a discussion of that. It taxes the very, very rich at a lower rate than it does working Americans. So these are just a few of the ways in which our tax code actually exacerbates the inequalities and creates structures which promote inequality.
And if we were to look at efforts to take advantage of those tax code failings and perhaps consider tax avoidance as an industry, how would you rank the size of the tax avoidance industry and its positive or negative contributions to society and the economy?
Tax avoidance industry has become a major global industry. It's partly a consequence of globalization. Globalization has expanded the scope for tax avoidance activities, and given an advantage to individuals and multinationals who operate in many countries because they can take advantage of these tax avoidance activities. They can afford the best tax lawyers who excel at tax avoidance. But one of the central points of my remarks, my initial remarks, was that those tax avoidance activities not only are taking away directly, that is to say, those tax lawyers are bright people, they could have been contributing to our economy, and instead they're trying to take money away from government. But they distort our economy. We have investments in real estate. We have investments in fossil fuel. We have investments in the financial sector that would not be there if our tax system hadn't actually encouraged those kinds of investments.
Thanks very much, Professor. I turn now to my distinguished ranking member, Senator Grassley.
My conversation is going to be with Dr. Faulkender. My Democrat colleagues talk a big game about making Wall Street pay their fair share. Yet many of the proposals we've heard discussed today, from taxing carried interest, the same as ordinary income, to imposing financial transactions tax, these have all been around for years, if not decades. Yet Democrats chose not to enact these proposals when they had a 60 vote majority during the Obama administration, or the last Congress when they rammed through 2 reconciliation bills on purely a partisan basis. Isn't it true that many of the tax proposals that we've heard about today haven't been enacted because Democrats' own failure to enact when they had that opportunity?
Yes, Senator, they could have done it through reconciliation, and they did not.
Okay. Won't the policies Democrats chose to enact as part of their unnamed Inflation Reduction Act overwhelmingly benefit large corporations as well as banks and even private equity firms?
Yes, there are a number of tax credit provisions and spending in the IRA that are going to go towards large industries and private equity firms, yes.
And as we've heard today, many on the left argue that unsustainable fiscal outlook can be solved through tax hikes on the wealthy and large corporations and Wall Street. As a result, the middle class has nothing to worry about, according to them. However, at the Budget Committee hearing last year, the majority witness, Bruce Bartlett, let slip the truth by saying this, quote, "I think we should raise taxes on the wealthy, but we're going to have to continually raise taxes on the middle class," end of quote. Isn't it true that this tax and spend agenda will ultimately require tax hikes on the middle class?
At these levels of spending, there is nowhere near enough wealth amongst the top 1% or the wealthy to cover all of those expenses and bring the budget into long-term fiscal sustainability.
The majority's witnesses discussed imposing a financial transaction tax, which is effectively an excise tax on every stock and bond transaction. Given that most Americans own stock and that more than 2/3 of the families participate in retirement plans, wouldn't a financial transaction tax hurt savers regardless of their income level?
Yes, they will get passed on to investors and savers, including investments through 401k plans.
Proponents of financial transaction tax argues it would promote market stability. Has that been the experience of countries who have implemented such a tax?
It is not, Senator. So when Sweden implemented one, they saw a reduction in trading volume, which is generally bad for market stability. You want to maintain liquidity through trading.
Okay, as you discussed in your testimony, Americans have been ravaged by high inflation, and the other side continues to propose tax increase after tax increase. Since the 2020 campaign, President Biden has pledged not to raise taxes on Americans earning less than $400,000. However, because of inflation, according to the Bureau of Labor Statistics, it takes $480,000 today to have the same buying power of $400,000 in the summer of 2020. Yet President Biden hasn't updated his $400,000 pledge. Isn't this another example of how President Biden's tax and spending agenda is a broken promise?
It is, because a lot of these tax provisions are not adjusted for inflation. Some in the tax code are, but this $400,000 has not, which means that over time it will hit the upper middle class.
Yeah. And in my few minutes, I'm going to make this comment about people talking about raising the marginal tax rate. I used to have a chart, and I don't suppose I've shown it for 10 or 15 years, but you can go back to World War II when we had 93% marginal tax rates. and you can go all the way through the 1960s, or even up until the 80s when it was still 70%, I believe, or became 70%. But if you looked at what the income coming into the public, it was pretty steady for that whole 30 or 40 years, which tells me that you can raise the marginal tax rate as high as you want to, but people that have the ability to make decisions that they're going to work for the government or not work for the government are deciding they're only going to pay X number of dollars, and you're not going to get another penny out of me, regardless of how high the marginal tax rate is, because they got the ability to hire the people to make every tax advantage so they get their taxes down to where they're willing to work maybe for 40%, like today, 42% that they pay in. It's just ridiculous to think you can raise marginal tax rates to 93% and you're going to get people stupid enough to pay 93% of their income taxes, so they're working for nothing. I give up.
No, you don't. You're going to be always fighting. You just yield. Senator Lujan, followed by Senator Johnson.
Thank you, Mr. Chairman. Dr. Stiglitz, I have some questions for you today. I've been hearing a lot about buy, borrow, and die. Can you explain what buy, borrow, and die is, Dr. Stiglitz?
What that refers to is the way so many of the share buybacks work. What you do is you borrow money from the market to finance your buybacks. You get deductions for your interest on your borrowing. The share buybacks are taxed at favorable rates, only the increment over what you purchased. And meanwhile, and this is probably the worst part, because you've reduced the number of shares of the company, this value, the price per share goes up, and the CEO gets a big bonus for doing nothing other than financial wizardry. It's nothing real. It doesn't help create jobs. It doesn't help the economy. In fact, it makes the economy worse because the company is now suffering from an additional liability from the borrowing.
And Dr. Stiglitz, in preparing for this hearing, of several studies that I found, the one I'm going to point to is some of the experts at Georgetown found that the wealthy avoid taxes for 75% of their investment income. Why is it that the wealthy engage in this tax avoidance strategy?
Well, it's because our tax code gives them the opportunity to do it. Over the years, I've seen the very rich engaged, particularly through hedge funds, in amazing strategies to avoid and, in some case, evade taxes. The worst get caught and have to pay back, but our tax code is just rife with these provisions that provide for advantageous treatment if you have smart tax lawyers.
And so, Dr. Stiglitz, trying to better understand tax policies that have been adopted in recent memory, namely under the previous president, there are estimates that have come out associated with what is a benefit to the wealthy from a stepped-up basis perspective. And the Joint Commission on Tax estimated that the step-up basis at death will cost the U.S. $299.3 billion from 2022 to 2026, or about $60 billion a year. And so I just want to take a moment to put that into perspective. I'm one of, I think, two senators right now that went to went to pre-K. I thought everyone went to Head Start. I didn't know that I had to qualify for the program. That's a joke. What I understand about universal pre-K is that it costs about $14 billion a year. So again, $299 billion is the number I referred to earlier. The Affordable Connectivity Program that provides affordable broadband to over 23 million low-income Americans costs $11 billion a year. The United States recently passed the Bipartisan Radiation Exposure Compensation Reauthorization Act to deliver long overdue justice to those left out of the original RECA program passed in 1990 and amended in 2000. And the New Mexicans who had the first nuclear bomb dropped in their backyards were left out. The program's supposed to provide compensation to downwinders and uranium workers, but it had expired on Monday. This just goes to show another area where investment from America could make a positive difference in the lives of so many that injustice has been the only thing that they've experienced. Now, Dr. Stiglitz, how does stepped-up basis and buy-borrow impact the ability of the government to fund critical programs such as education, healthcare, housing, and infrastructure development?
To focus on the step-up basis, it's a mechanism by which rich people totally avoid paying taxes on the income that they've accrued, the capital gains that they've accrued for years, in some cases, decades. So while ordinary people are paying taxes year after year, if you get your income in the form of capital gains, you can postpone it. And then with a step-up basis, you never pay for it. One of the things that I argued in my introductory remarks was that constructive realization, where you force individuals to pay year by year on their capital gains as they accrue, would be an important step forward. But if you don't do that, it's absolutely imperative that you have this step-up of basis. And as you pointed out, the revenues lost are very large and could be used in so many constructive ways. You gave a couple examples. There are more we could talk about. Enabling students to go, more students to go to college. Tuition has gone up enormously. So there are a very large number of very productive investments yielding very high returns that would be able to be financed by the revenue you could generate from those two proposals that you talked about.
Thank you. Thank you, Mr. Chairman.
Senator Johnson, followed by Senator Merkley.
Mr. Chairman, we're trying to scramble to get the chart, my own version of the chart that Senator Grassley was talking about. Hopefully we can get it up here before I'm done. I'll just ask all the witnesses, anybody want to defend the current tax code? Anybody think it's a great code? Okay, silence. It's way too complex, right? So when you have something really complex, that's something that can be taken advantage of, correct? So shouldn't our efforts be, rather than reforming the tax code and try and continue to socially and economically engineer through the tax code, wouldn't it make a lot more sense to simplify and rationalize the tax code? Mr. Faulkender.
It would indeed, and that's, one of the things we tried to do in the Tax Cuts and Jobs Act was by doubling the standard deduction and removing some of the deductions for other items was to encourage more people, to encourage fewer people to itemize and more people to take the standard deduction, thereby making it less complex. But unfortunately, people then still calculate it both ways, and we didn't succeed in doing that.
Right, it's complex because you have all these special interests from all over, from all ends of the spectrum, coming in here and carving out a little special deal for themselves, so it ends up being incredibly complex. So let's put this chart up here. This is what Senator Grassley was talking about. I mean, this is the futility of trying to punish individuals, trying to punish their success. It just doesn't work. People aren't that stupid. They're willing to hand over so much to government and no more. Ms. Anderson, I want to ask you, what percent of an American's income, of a dollar of income, should the federal government be able to extract? What's the maximum tax rate? Again, I'm just talking about the federal government now. What do you think?
I'd be happy to give you my preferred top marginal tax rate.
Well, what is it?
Once you close the loopholes that make
Okay,
a
well,
mockery
I'm assuming,
of the top tax
okay,
rate.
let's call it the effective tax rate. Okay,
No.
what is the maximum amount anybody ought to pay after all the deductions, that type of thing?
Since people are not paying that at the top level, we have billionaires paying an
I
effective
didn't know, what is the
8.2%
maximum, just
rate.
give me, what do you think
Yeah.
is the most anybody should pay out of $1 of income?
Yeah, it's not about, that chart is not about
Dr.
futility.
okay, I'm
That
not gonna-
chart is
Dr.
about
Stiglitz.
loopholes that members of Congress have
I
allowed
got
in the
limited time.
tax
Dr.
code.
Stiglitz, what do you think the maximum amount anybody ought to pay out of $1 of income?
I think you begin by asking the question, how do you close the loopholes? And how do
Guys,
you make sure
just,
that
this is,
people
it's a very
pay
simple
their
question.
fair
What is the
share?
maximum amount any American ought to pay out of $1 of income? It's a very simple question. Again, eliminate all the loopholes, but I mean the effective rate. What is the maximum amount somebody ought to pay?
Again, one of the things I said is if you derive your money from land speculation, you should pay a very, very high tax rate.
First of all, income,
and there's a
first of all, let me
difference.
say, to simplify the tax code, income should be income. You know, there is a rationale for a lower tax on capital gains because you're taxing the inflationary gain. So you could index the inflationary gain and then tax it at the individual rate. Here was my proposal in 2017, 2018. I call it a true Warren Buffett tax. Tax all business income at the ownership level. Okay? 95% of American businesses are pass-throughs. It's entirely possible. I talked to Warren Buffett about this, talked to his shareholder services people. You can allocate income, and you tax income every year, allocate it, and tax it at the ownership level. You could have corporations do a backup withholding. All kinds of advantages of that plan right now. Parts of it are being scored by JCT, hopefully. The chairman of both this committee and the finance committee. I know Chairman Wyden is interested in it. So again, that would be a simple system. And by the way, it would be able to, you wouldn't have that locking up of unrealized profit in C Corps. It's just, again, what's going to happen in 2016 is a gross distortion and put small companies, 95% of American businesses, at a huge disadvantage to the big C Corps. So we need to address that. But Mr. Faulkender, why don't you comment on what I'm talking about there? And I don't think you've ever seen that plan.
No, I've heard you talk about it, but I haven't yet seen the details, and I look forward to seeing the score come out. But yes, if we could do everything as a pass-through, you'd eliminate some of the distortions that are created by changing your tax structure all to have a lower rate either as a C Corp or an S Corp. What we ought to do is tax all income uniformly and stop saying if you spend money the way government wants you to, you have a lower or a no tax rate than if you don't do it than if you spend your money the way you want to.
So you agree, we do a terrible job socially and economically engineering through tax codes, so stop doing it.
That's right.
Use the tax code to collect the revenue the government needs as simply and fairly as possible. That ought to be our effort. Rather than talk about these all complex things about a billionaire tax, let's simplify this thing. Let's rationalize this. That's what I'm going to try and push for over the next couple of years.
Yeah, lower the rates, broaden the base, stop picking and choosing winners and losers through the tax code.
By the way, one principle that we should abide by is wherewithal to pay. So trying to tax unrealizable capital gains would be disastrous, okay? But again, I hope the chairman takes a look at my tax plan because it makes a lot of sense.
I'm sympathetic to the senator's concerns, and I appreciate the enthusiasm with which he pursues them. I do think that when it comes to the question of what the tax rate should be on $1 of income, it matters whether it's the first dollar or the last dollar, and it matters whether it's the 10,000th dollar or the 10 millionth dollar of income for that individual.
But you're complicating the question. Again, it's just like overall.
Yeah, but
the
it
effective
matters.
tax rate. What should be the max? Do you want to tell me what you think your maximum should be?
I don't, because you got to know what the dollar is. If
Well,
it's the
say
last dollar,
say it's a person who's
and it's
earned $1
10
billion. Say someone earned $1 billion. The last dollar, how
They
much
don't
should it be
even know it
taxed?
exists. I think
How
you
much
get
should be?
taxed.
What's the percent? What percent? The last dollar of $1 billion. So now I'm giving
I
you
would
your
say
information.
way above 50%.
So what? What
Because
should
the
it be?
billionaire doesn't even know that dollar
So,
exists.
so what? So how? What should
But
it be?
it's very different if
Way
somebody's
above-
making
no, 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 no.
$30,000 a
You
year.
asked a question. Which dollar is it? It's $1 billion. Someone earned $1 billion one year.
Well
Bill
over-
Gates earned $1 billion. What should be taxed in the last dollar?
Well over half.
How about $1 million then, as long as you're listening?
70%?
We're into Senator Merkley's time. Senator Merkley.
Thank you, Mr. Chairman. And this issue of our tax code is fundamental because we do so many different things with it. But one of the things that it certainly does is accentuate the wealth of the wealthiest individuals. My father, the mechanic, would ask the question, why is it that working people who earn their income by the sweat of their brow pay a higher marginal rate than do millionaires getting a return on their already existing investments? And I think it's an important question to continue to ask. But I wanted to turn, Mr. Stiglitz, and good to have you here, to the comment that President Trump made recently when he told some of the country's wealthiest political donors they should increase their donations from $2 to $3 million to $25 or to $50 million in support of his election because his tax policies would benefit them far more than would Biden's tax policies. And so I want to know to what degree Mr. Stiglitz would retaining some of the cuts for the wealthiest individuals and the corporations from the previous Trump tax cuts, or increasing those cuts, how would that benefit ordinary Americans?
Wouldn't, and it actually would harm the economy. I was asked in the beginning about the relationship between economic performance and inequality, and I said the evidence now is in, it's very strong, that a more unequal society performs better, grows more poorly. A more unequal society performs more poorly, grows more slowly, and greater financialization is bad for economic stability, and our tax code encourages that. Our tax code encourages more speculation, and that's bad for the ordinary citizen. So the extension of the kinds of policies that President Trump enacted would, I believe, be not only bad for the typical American, but be bad for our overall economy. Remember, the tax cuts that were enacted in 2017 went overwhelmingly to those at the very, very top.
Mr. Stiglitz, then I want to shift to, I just had a series of town halls this weekend. I have a town hall in every county every year. I was in towns that basically I lost these counties by 30 to 50%. So they're not what you'd call my base electorate. And the issue that came up most over anything else was the high cost of housing. So this is very much a factor in urban America. It's a factor in rural America. People are watching the dream of home ownership disappear before their eyes for their children. We have a number of programs for more affordable rentals, more affordable first-time home ownership. But one of the things that I've been directing some attention to is the growing role of hedge funds in buying up American single-family housing. What we saw in 2009 after the foreclosure crisis is the government sold houses in groups of 1,000 or more, and no ordinary American buys 1,000 houses. Hedge funds, where the investment of millionaires and billionaires exists, buys those houses. They were being sold at 50% discounts. I suggested they make them available to ordinary families. I took this up with the Treasury Secretary as a brand new senator. I took it up with the President to say, make them available for 3 to 6 months to ordinary families. And basically the response was too complicated, too many homes to dispose of, too worried about vandalism, frozen pipes, so on and so forth. But the hedge funds from 2009 forward have now recognized that there's this enormous slice of the American pie that was the major wealth builder for middle-class Americans. And the hedge funds want to take that off the plate of middle-class Americans and put it on their plate. It's estimated that by the end of this decade, the hedge funds will own some 40% of the single-family rental houses in America. And right now, we see in some markets the hedge funds buying some 40% of the single-family houses available. In Oregon, we hear the vignettes of people saying, my realtor told me I was outbid by an all-cash, no inspection offer. Who makes all-cash, no inspection offers? Is there any logic to saying that we should keep home ownership, single-family home ownership, on the plate of middle-class Americans? And I've specifically proposed that hedge funds cannot buy any more single-family housing, that they have to sell what they have over a 10-year period, 10% of it, their housing stock each year. Is there a reasonable argument to say that in terms of equity, under how we approach the opportunity and the stake in our society for ordinary working Americans, hedge funds shouldn't be in the single-family housing market?
Well, first, let me say that I do think home ownership is very important. It's important for community stability. It's important for engagement in all kinds of participation, education, local schools, and so forth. Secondly, let me say that the tax code has given benefits to the hedge funds, and the tax code has broadly, in the real estate sector, contributed to real estate speculation, land speculation, which increases the price of land and makes housing more generally less affordable. The third thing is, in some communities, there is real concern that they own a sufficient fraction of the housing that you no longer have a competitive housing market. And that allows them to raise prices, to take advantages of the tax code and of market power. They're in there not to make people happier, they're in there to make more money. And it's become an attractive venue of money. And when you think of they're making money, who is the money coming from? It's coming from ordinary Americans. It's just a transfer. And so you're absolutely right, Senator, that it's a transfer which not only increases inequality, but I think undermines the American dream, undermines our communities, and undermines the opportunity for the typical American to make his way up in the world.
And I'll just close. I know I'm over time, so I'll just close with this comment that the tax code very much plays on why this is such a profitable enterprise. Untaxed appreciation and artifice of depreciation, which is just a tax shelter, and untaxed interest for the funds to actually leverage their funds to borrow more and not pay taxes on that interest. So there's several features that really help drive the profitability for hedge funds.
Senator Romney.
You're absolutely right.
Senator Romney.
Astonishing. I'm delighted that we're talking about things that relate to our deficit. We should have been doing this for a long time, and I appreciate the fact that we are. Recognize, of course, that this is not about gathering information and making decisions. We've never met as a committee on these things privately. You're seeing our full discussion of tax code right now. We're here to perform for an audience, but the joke's on us, because basically no one's watching. Right? This is not something that the American people are tuned into. That doesn't mean it's not important. I will note that things, it's not my quote, but it comes from another famous economist, that things that can't go on forever won't. And continuing to spend massively more than we take in and adding every year massively to the national debt will not go on forever. And unless we deal with it in a constructive way, we will have a financial catastrophe at some point. I can't tell you when it is. Hopefully we'll deal with this issue and don't have the catastrophe, but that's going to be a challenge for us. I would note it's not just spending. It is both spending and taxing. You have to do both in order to reach balance. If somehow we were able to magically stop all spending other than military that we vote on every year, we eliminated all of government, kept in place, of course, the entitlements that are mandatory, but all the rest of the government we got rid of, we still have a deficit. So we're going to have to look both at spending and taxing. I keep hearing this idea that there are corporations that are very profitable that pay no tax. Now, I can't figure out how that is. Because if they're following the government tax law that we've written and that Congress has approved and the president signed, and they have a profit, they have to pay a tax on that profit. Is that right, Ms. Anderson?
There are many tax avoidance strategies from
No.
tax havens.
Answer the question. If a company follows government tax accounting policies passed by Congress and the president and shows at the end of the year, let's say, $1 million profit, they have to pay a tax on that profit of 21%. Is that right?
Unless they're getting other tax credits that balance that out.
But if they have other tax credits, that means that's following the government account, the things we've passed in Congress. My point is this, which is companies that are profitable under the law that we've passed are paying full taxes. So if you think there are companies out there that are massively profitable that aren't paying taxes, that's just not true.
I wish
What
there
it
was
says
more
is,
transparency.
excuse me,
on
I'm
how they're
speaking
getting
now,
away with it.
not your turn. So what that says is, if we don't like the taxes companies are paying, then let's be honest about it and change the federal law. But companies are paying taxes as we have passed them. What's being said is dishonest when people say, oh, all these companies are earning all this money. What they're referring to, I've tried to ask, what are you talking about? They say, oh, we're talking about Wall Street accounting, not government accounting. You see, companies are paying full taxes under government accounting, but then the politicians look at Wall Street accounting and say, oh, they're making profit there, they should pay a tax on that. That's a different matter. So let's be honest in how we deal with that issue. CEO pay as a ratio. The idea you indicated we should pay or charge CEOs based upon the ratio of their pay to their lower employee wages. Do you know what companies would do in that circumstance? Think about unintended consequences. And that is, companies would separate their employees between two different companies. And low-income people would be part of one company, and higher-income people would be part of the other. All right? You have to recognize that the kinds of things you're suggesting have massive unintended consequences. The idea of taxing people based upon their assets, which Dr. Stiglitz suggested we had to do, based on their net worth, not their income, but their net worth. Do you know what that would do? France found out. They tried that. They had 60,000 multimillionaires leave the country over the course of about a decade. They stopped doing it. There's no other country in the world that taxes people based on their assets because they realize people flee when that happens, move assets other places. Unintended consequences. Look, we're going to have to do things that do raise additional revenue, and we're going to have to do things that cut spending. We've got to do both, but we've got to be honest with each other if we're going to do that in a reasonable and fair way. And I would note, just as a small subpoint, the idea of eliminating the tax-free step-up at basis and death is one thing we ought to look at and probably make sense. All right? I do think that when we look at taxes, we have to say, which things can we adjust that won't hurt the growth of the economy? Because most of what's been described today is, in my opinion, going to be highly detrimental to the growth of the economy and the capacity of America to create jobs and lead the world. Don't forget, our economy is leading the world. Don't broke what ain't, or don't try and fix and break what's actually working pretty well. And let's fix things that we can to finally rein in the excessive spending and deficits that we're seeing. Mr. Chairman?
Thank you, Senator Romney. Senator Van Hollen.
Thank you, Mr. Chairman. Always good to listen to our colleagues, like Senator Romney. I would just make a distinction between those individuals and corporations that are not paying their taxes that are due and owing versus those that are making payments compliant with the law. And in those areas, as you said, Senator Romney, some of us think that the current law does need to be changed to create a more sort of productive economy and not reward excessive risk-taking by CEOs, for example. But just to be clear, the funding that was requested for the IRS, which House Republicans anyway have tried to zero out over time, is designed to make sure that people pay the taxes that are already due and owing, and it amounts to huge sums of money every year, according to many economists. So thank you, Mr. Chairman, for holding this hearing, and all of the witnesses for covering some of these issues. I know the carried interest loophole has been covered. I think if you look at our current tax system, it's riddled with provisions that need to be revised and reformed, both to sort of encourage more productive investment, but also to raise funds that are important to invest in things like education, healthcare, and our people. Ms. Anderson, you mentioned in your testimony the effort some of us have been pursuing with regard to Section 956 of what was back in the day the Wall Street Reform Act. One of the things we saw during the 2008 financial crisis was how big firms paid out tens of millions in bonuses to CEOs, in many cases that were from the same firms that U.S. taxpayers ended up bailing out, which is why many of us have been working to try to ensure that federal agencies implement Section 956. The Federal Reserve has been a laggard here. Could you just speak to the importance of doing that, and how many of these bonus systems simply reward short-term risk-taking at the expense of other investments on behalf of firms and their stockholders?
Yes, and I want to thank you, Senator Van Hollen, for your efforts to finally get this part of the 2010 Dodd-Frank bill implemented. This is the part that bans Wall Street firms from providing incentive compensation that encourages inappropriate risk. And 6 different agencies have to agree to it, and so it has gotten dragged out far too long. We're hoping to see action in ways that would incentivize Wall Street executives to think more about the long-term value creation instead of complicated schemes that can blow up and put the rest of us at risk. For one thing, they could require them to put a share of their incentive compensation into a joint fund that could be used to pay any potential penalties against the company for fraudulent behavior. But there are a lot of important ways that are on the table and being discussed to finally get that regulation over the line in a way that I think will mean that we're all safer from the kind of risks we saw in 2008.
Well, thank you for that, and we are continuing to push all the federal agencies to move forward on those rules. Dr. Stiglitz, thank you for raising the issue of tax treatment of capital gains at death. As you know, current law, including very large exemptions to the estate tax, entrenches and accelerates wealth inequality. In fact, it's one of the larger sources of just wealth being passed on from generation to generation in huge amounts, essentially avoiding any taxes, any commitment to the public good in the process. Could you just talk about why we need to address this issue and how failure to address it contributes to increasing wealth inequality in the United States and reducing investments in productive areas?
Well, first let me say that it also contributes to a sense that the tax system is unfair, because what it means is that the income of individuals that is earned in the form of capital gains is never, of these rich individuals, is never taxed. So while ordinary people may be taxed at 25, 30%, those who can take advantage of step-up basis and receive their income or convert their income into capital gains totally escape that taxation. And because they escape that taxation, the wealth, they're able to pass on so much more wealth to the next generation, who then can engage in that same activity over their lifetime. And so you have the creation of a plutocratic country.
Well, thank you for summing that up quickly, and it's one of the areas that I and others have been focused on, and look forward to continuing to work with you, and appreciate all the work that you've done in this area over many, many years. Thank you, Mr. Chairman.
Thank you, Senator. I'm going to wrap up the hearing here. One of the things we do in the hearing is ask witnesses to answer questions for the record. And Dr. Stiglitz, in particular, I'd like to ask you a question for you to get back to us that relates to climate-related risk and the extent to which it appears now to be adequately or inadequately accounted for in the corporate sector. We've heard again today my Republican friends trying to insist that there is a difference between climate risk and economic risk, that the two are unrelated. We've had abundant testimony from very expert and highly regarded people who are bound by fiduciary responsibility, who point out the exact opposite. I happen to believe that climate risk is the biggest looming risk over our economy, that climate risk is economic risk, and that economic risk is budgetary risk. Indeed, a third of our debt has come from economic shocks, not just from the erosion of spending over taxation and income. We talked about the 2008 shock and its role today, and the chief economist for Freddie Mac warned that we got another one coming just from coastal property values being hit by the insurance failure that followed by mortgage failure that follows by values failure, and we've had other witnesses confirm that testimony. So I just flat out reject the notion that climate risk is not economic risk, and that economic risk is not a huge budgetary risk. I think all of the evidence runs to the contrary. And in that regard, Dr. Stiglitz, you watch all of this very carefully. You've provided excellent economic testimony about climate risk. And I'd love you to answer in a written QFR how well you think at the moment the market is assessing climate risk and how well you think corporate reporting accounts for climate risk. Would you be willing to do that?
Very much so, and you're absolutely right. Climate risk is an economic risk. It is a budgetary risk. And some people think because climate change is out there in the distant future, it's not something that we have to pay attention to today. But that's not true. We're already getting some of the direct effects on, as you mentioned, in terms of extreme weather events, and in terms of coastal properties being adversely affected. But there's another effect that I would want to emphasize, which is at some time in the not too distant future, markets are going to wake up and realize that we can't go on with fossil fuels. And when that happens, there will be a reevaluation of the price of fossil fuel related corporations, activities. And if you thought that there was a big shock from mispricing of residential real estate mortgages, this is an order of magnitude larger. And hopefully it won't happen. The market will realize this more gradually. But where we are right now, the market has not taken these risks on board, and it could come as a very big shock to our entire economic system.
Well, I'd ask you to write that out for me as a response to a question for the record, and also to touch on how effective you think the new SEC proposal will be in improving the climate risk reporting. And with that, let me thank the witnesses for appearing before the committee today. Questions for the record, other than the one I just asked, will be due by noon tomorrow, either to the committee clerk or by email. We will ask the witnesses, Dr. Stiglitz, this would be you, if you wouldn't mind responding within 7 days of noon tomorrow. That would be very helpful to us as a committee to have your response in by then, and ditto to any other questions for the record that come in by noon tomorrow. With no further business before the committee, our hearing is adjourned.